topic we're going to talk about, you guys, is enterprise risk management. Enterprise risk management is really, it's an approach to managing risk in your organization. So it's a process, and if I were to give my own definition, ERM is a discipline that addresses an organization's full spectrum of risks, and it seeks to manage those risks as an interrelated portfolio. And this is all in support of achieving an organization's goals and objectives. So it's a different way of looking at risk. It's a way of looking at risk as an opportunity. So if I were to use an analogy, an organization that doesn't have a sound risk management process or way of organizing risk is really kind of like a plate of spaghetti. So I've got 3 little kids, a 6-year-old, a 3-year-old, and a 1-year-old. We see a lot of spaghetti and a lot of waffles in our house. So I came up with this analogy to think of, if your organization doesn't have a process for actually identifying and managing risk, then it's really kind of like a big tangled plate of spaghetti. If you look at spaghetti, you can't eat that in a very organized way. You don't know where one starts or one stops, where a noodle starts or stops. But contrast that with a waffle. An organization that has a sound enterprise risk management process, think about a waffle, it's organized, it's symmetrical, you can bite off 1 square at a time, you can save a square for later if you want to, or you could throw it in the trash and totally avoid it. So enterprise risk management is really basically like taking an approach to risk like you would eat a waffle. Enterprise risk management has really a 6-step process that I'll walk you through quickly. We have successfully implemented this with a number of our clients. In my past life, I've worked with some large national financial institutions, and we've worked with some professional sports franchises to implement this process as well. So the Enterprise Risk Management Committee really starts with a point person that's going to identify director level people, management level people, to be on an ERM committee. And the folks on the ERM committee are going to be responsible for identifying risk in the organization. How are they going to do that? They're going to interview people that they would identify as stakeholders. So stakeholders you would define as anybody in the organization who's kind of emerging as a leader, somebody who has maybe identified risks in the organization in the past, who brought things up and said, hey, this is around the corner, we should start thinking about this. So when you interview the stakeholders, the committee members are going to start to ask them questions like, what keeps you up at night? Or what do you think could potentially prevent us from achieving our goals and objectives as a company, or even in your own separate division? What are you worried about? So from there, you'll start to compile a list, and what's interesting is you'll start to see that there will be trends, there will be things that people will mention over and over again. In the construction industry, probably various divisions you would start to see the same risk over and over, that people are concerned about the labor shortage. So if we have high turnover, if we have retirements, how are we going to replace these people? So if you see that over and over again, then you're going to start to prioritize that risk differently. So that's in the risk assessment phase, where you're going to start to compile that data and really start to rank it. And the way that you rank it is pretty simple. I mean, it's really just what is the highest likelihood and the highest severity items that start to move to the top of the list. And again, we're talking about things that might not be traditionally insurable. We're talking about things that could potentially just be on harm to the balance sheet. So from there, we start to go to response strategies. So response strategies are ways that we can either avoid a risk, mitigate a risk, or transfer a risk. Those are the 3: avoid, transfer, or mitigate. Those are your response strategies. So to use an example there of a response strategy, it might be, if you work for an organization that's a large fleet of trucks. One of the big pushes these days from a mitigation standpoint is telematics. So telematics are the technology that go in your vehicle to monitor driving activities. That's a risk mitigation technique for a company that has a large fleet of vehicles. Or within that assessment process, if the risk, is the fleet, they might say, we're worried about the fact that we've seen in trade publications or on the news that construction companies are having judgments against them in some really large auto accidents. If you guys have paid any attention to that, or I'm sure you've seen your auto rates are going up. I mean, the auto industry, or at least the auto insurance industry, is kind of spinning out of control. So there's been some really, really large judgments, really large awards. You could be worried about the fact that you don't have high enough umbrella limits. So in order to transfer that risk, you decide to buy higher umbrella limits. So you're evaluating response strategies based on what's the most appropriate way to respond to that risk. So from that stage, the next step is to, in between evaluation and implementation, is to assign a risk owner. So you assign a risk owner that sits on the ERM committee who's going to see everything through, see the response strategies through the implementation stage to the monitoring stage, and report back to the committee. So, in that example in telematics, what are we doing to actually monitor that information? And is it working? Is it actually changing behaviors? And then reporting back to the committee. So this is actually a cycle that never ends. And the way that we have advised our clients is to meet as an ERM committee on a quarterly basis. And the reason for that is really because of these top 2 points here, because you want to have a constant process of monitoring how your implementation strategy is working, and then identifying new and emerging risks. Because as the economy changes, as technology changes, we need to have a mechanism in place for identifying emerging risks. I mean, think about it, we weren't talking about drones 5 years ago, and how many clients of ours in industries that you wouldn't expect own drones all of a sudden. Creates liability issues, property damage issues. So things are changing quickly and we need to be prepared to identify those. Some of the advantages of a successful enterprise risk management program, it really just creates a mechanism for identifying, prioritizing, and evaluating all risks to your organization, not just the insurable risks that you typically think of. It creates a culture of accountability. And through having those risk owners, it really designates individuals and holds them accountable to seeing those mitigation strategies work. You start to view risk as an opportunity instead of a weakness, which is just a different way of thinking. It's actually something that we can use as a point of leverage to make our organization stronger. It requires that you have sound loss control and risk mitigation strategies in place. So you might work for organizations that have safety directors or somebody who's responsible for safety. It really starts to push that accountability out to all levels of the organization, not just one individual. Ultimately, the goal here is to lower the total cost of risk. So total cost of risk is something we talk a lot about to our clients. Total cost of risk is really kind of an all-encompassing look at how risk affects your balance sheet. So it's not just your insurance premiums, that's one component of it. It could be a combination of your insurance premiums, experience mod rating, your deductibles, your health insurance spend, everything that goes into managing risk within your organization. So ultimately, a sound ERM program pulls down that total cost of risk. Any questions so far? So the question is, we've seen this before, especially in organizations that have kind of limited access to the insurance marketplace. There's not a lot of insurance companies that actually want to write that specific type of business. So what happens if your risk management engagement's high, you have a ERM program or at least a sound safety program, you have low claims. So what happens if that total cost of risk doesn't really get pulled down at the level you wish it would have? What if it doesn't work? And the question really is, what if you still feel like you're being cursed by the insurance gods? Because it feels like sometimes there's a divine power out there in the insurance world that controls everything, right? Well, we want to help you take control. That's really what we do with our clients. And we start to talk to them about alternative risk financing. And the first thing, and we talk to a lot of our construction clients about this, is group captives. Group captives specifically for property and casualty. So, and by property and casualty, I should back up, really only referring to 3 lines of insurance coverage. That's general liability, auto liability, and workers' comp, just those 3 lines. And I'll explain that more in a second. So, why do people start to entertain group captives? There's a lot of reasons, and when we poll our clients, they start to get fed up with traditional insurance because there's a lack of transparency. You don't really know where your money's going. You don't really know how much money your insurance company's making. You don't know how much money your broker's making. Where's the money going? You start to realize that if you're a sound organization that doesn't have a lot of claims, you're subsidizing poor performing peers that are also buying traditional insurance. So we see this, right? We talked about auto insurance rates. I mean, think about even your personal auto. You may have never had a claim on your personal auto policy. I guarantee your rates are going up. And if they're not, you should check, because I guarantee they are. So you end up paying for the poor performers. There's marketplace instability. So things that affect the insurance marketplace are things like stock market, capacity in the marketplace. When there's natural disasters, big catastrophes like the wildfires we've seen over the last couple of years, it starts to shrink capacity, so rates start to go up, even if it had nothing to do with you. They get sick of the 12-month buying cycles. So, if you've been on the insurance buying side, it seems like, gosh, every 12 months they're having the same conversation over and over again, with very little kind of long-term strategy in place. It's just a year-over-year discussion. And then probably one of the biggest things is, has anybody ever had, I don't know if you've ever been insured with Travelers, not to pick on Travelers, but you've had a really great year with no claims. The Travelers come back out and say, thank you, here's a check. Here's some additional premium. Just get such an awesome year. This doesn't happen. I mean, that's how carriers make money, right? They want to make sure they are betting that you're not going to have claims, and that's how they retain profits. And they're not going to get it back to you. So contrast that with group captives. Basically the exact opposite of the reasons that our clients get interested in them are those unused loss funds that don't go to pay claims. That premium that you pay in can be returned to you. It's a multi-year strategy. So we really look at the captive performance in 3-year and 5-year chunks, not just 1-year chunks. If you're entering into it thinking of it in traditional 12-month buying cycles, you're thinking the wrong way. There's an absolute big-time focus on loss control and risk mitigation because basically it's your money on the line. You have more skin in the game, you have more risk, so you're going to really invest in avoiding things or at least mitigating things from happening. It's immune from marketplace changes, so if you're in a group captive, pricing and the performance stays within the group. So pricing is based on your own performance and the group's performance. It doesn't really matter what the broader insurance marketplace is doing. And then finally, there's extreme transparency. So you see where every single one of your dollars is going inside of captive.
All right, real quick. You guys chilly or everybody good? Is that door still? Okay. Thanks.
It was about 82 degrees in here when we started, so.
Your hands are probably a little chilly now.
Didn't want to push you to sleep. So again, we're only talking about 3 lines of coverage, just as a reminder: general liability, auto liability, and workers' comp that go into a group captive. So what does that really look like? This is a typical program structure that you might be familiar with. In an insurance construction company, you're going to buy general liability, work comp, and auto, and then these lines that are in teal are really going to be the lines that are in the group captive. Anything ancillary to that, umbrella liability, property, inland marine equipment, or maybe employment practices liability, you're still going to buy traditional insurance products for those things. So it's still just a traditional purchase for that, and it'll still be a 12-month buying cycle. So this is where it can start to get a little bit complicated, so please feel free to ask questions. The way to think about a group captive and then the funds that are available is to think of these 3 lines: general liability, auto, and workers' comp, are all kind of sharing one big bucket of money. And there is a frequency fund and a severity fund that are allocated to pay claims based on how big those claims are. So within the frequency fund, you will have money that will be set aside within the frequency fund to pay claims between $0 and $100,000. So those are those smaller, more frequent claims, and those are 100% your claims to your company. So anything that happens between that $0 and $100,000 layer comes out of the frequency fund. Within the severity fund, that's going to pay for any claims that you have that might go above $100,000. So you have let's say you do have $1 million claim, $100,000 is going to come out of the frequency fund, 300 out of severity, and the rest will be paid by reinsurance. That's the way that works. The thing that's a little bit different about the severity fund is that that's where shifting and sharing happens. So when you're captive, one of the advantages is that you have economies of scale, for buying reinsurance and everything else available when you're captive as a group, but you also have a little bit of risk in shifting and sharing. So if another member's funds get depleted in a year, then everybody's got to chip in a little bit. And that's where people start to get kind of freaked out. But what the numbers typically are that we see are between 5 to 7% of your premium because of shifting and sharing, so it's not actually a lot of money. And then, of course, on top of that, you have reinsurance. So your fronting company is the insurance company whose paper the insurance policies are issued on. And that's going to be your typical insurance companies that you guys are used to seeing, Hartford, Arch, could be Zurich. They will issue the insurance policies, and they will typically provide the reinsurance as well. So when you are in a captive, those certificates of insurance that are so important to you to get a job, it's still going to say Zurich on the paper. It's not going to say, Joe Blow Insurance Company or something kind of sketchy like that. It's still on AM Best rated paper. So everything should still be compliant. Any questions so far? So how is pricing calculated? It's kind of a big question. That first fund that we talked about, the frequency fund, which is sometimes referred to as the A fund, it's really based on, if you're going into the captive in the first year, they're going to take a 5-year history, 5-year snapshot, and look at the claims that actually occurred between $0 and $100,000. And they're going to base pricing on that. They're going to say, how much money on average would your company need to pay those claims that occur between $0 and $100,000? And so that's how they base the frequency fund premium. The severity fund then is going to be based on the entire group. So if you look at the entire group, what has their historical claim performance been like between $100,000 and $400,000? And so they base the premium for that, based on that, and you're a pertinent share of that. And then there's acquisition costs, of course, right? Acquisition costs are sometimes referred to as fixed costs, but those are they're expenses to actually run an insurance company. So you now own an insurance company, and you have those acquisition costs for reinsurance, claims handling, loss control, the fronting company. Usually ends up being about 1/3 of your premium. So there's a lot of numbers up here. This is an actual client of ours and this is just one of the exhibits that we provide to our clients when they're considering a captive. But the point here is really just two main things that I've circled. On average, this client over a 5-year history had about a 30% loss ratio, which is good, right? 30% loss ratio means that the insurance company is making around 30% on their money if their acquisition costs are 40. So they're making about a 30%, they have about a 30% loss ratio. In the guaranteed cost traditional insurance marketplace, they're paying about $447,000. Over those 5 years, they've on average paid out about $110,000 by 15 claims. So if we carry forward the cost of the captive and compare it to guaranteed costs, the captive net cost is $283,000 on average at a 30% loss ratio. And that would represent a savings of $164,000 a year. So take that times 5. This is a home run for that client. They don't have too many vendors that are walking in saying, I can save you over $500,000 in a 5-year period. So this is a really compelling case. We've seen them actually even in the 7 digits before.
What premium volume level is required for a captive to make sense?
I'm going to get to that in a second, but it's $250,000 is usually the place where it starts to make sense. I mean, obviously, the more money you're paying in, the more potential you have for savings. at $250,000 level, it's kind of sometimes a little bit sketchy, but 250 is the number. So when we pull our clients, and we've got several clients that are in group captives, what we ask them, what are some of the pros and cons that you've seen of joining after you've experienced this? What do you like and what do you dislike? And of course, number one of the things that they like is the distributions. They're getting money back, right? So we've got several clients that have gotten six-figure checks, after being a captive. So they love that. Of course, it takes time, but they love that piece of it. They like the high accountability. So it's high transparency. Members get to know each other. Other members can actually see how you're performing in the captive, and so there's accountability across the fellow members. But then there's high accountability within the organization now because they've got more skin in the game. And of course, they love the stability. There's several clients that we have that joined a captive because the market was always so constrained. We had so few options, and they just got sick of the insurance company basically always having the leverage. So the captive actually let them take control back. Some of the cons are delayed gratification. So what I mean by that is those distributions that you can get back. Let's say first year joining the captive, you have an amazing year, you have no claims, you're expecting to get a lot of money back. You're going to wait at least 3 years to start getting that money back. So you're going to have the first year, the second year, the third completed year before you're going to get your first distribution back for that first year. If that makes sense. And they'll still withhold a little bit of money because claims develop. Claims reopen, they have some life to them. So you don't actually get 100% of your money back right off the bat. It just takes some time. There's no secrets in the captives. That's the opposite. For people that really like the transparency, sometimes it's too transparent for them. We've had clients, and you have this within your authority if you're a captive member that have essentially forbidden competitors from joining their group captive. So if you have a geographical competitor that's thinking about joining your group captive, you can say, you can give them a no vote, you don't want them in because you don't want them to see how you're performing. The max cost. So if I were to back up just a couple, or actually this last slide, you can see that if you had a really bad year, let's say you had a 100% loss ratio year, like on this line right here, and you ended up paying $367,000 in claims, the net cost of the captive is actually more than you would pay in the traditional guaranteed cost marketplace. So your potential max is higher. If you're buying traditional insurance, you know what you're paying for that year. And the insurance companies aren't going to pay those claims. So the potential max cost year over year means that there is definitely some risk that it's going to be a little bit more expensive. So to get to your question, and specific to construction firms, what kind of construction company is a good fit to consider a captive? It really starts at a minimum premium of $250,000 for those 3 lines: GL, auto, work comp. The sweet spot really is $400,000 to $900,000 in total premium. Reason why? There's not a lot of options for companies that have premiums of that size, at least for loss sensitive. So by loss sensitive, I mean high deductible plans, retrospective rating plans, things like that that traditional insurance companies offer. They won't offer those to companies that are between $400,000 and $900,000 typically, or at least it won't make economic sense. So that's where it's a great fit for captive. Organizations that have a great commitment to risk management and safety, so you actually get graded on that before you can join a group captive. We actually administer those tests before our clients join, just to see if they have anything they need to work on so that they can study hard and get a better score. But you have to have a strong commitment to that to be able to join. Good loss experience, of course. So if you've performed really well from a claim standpoint, then it's going to make, the math's going to make sense. You need to have an EMR experience level rating below 1. And then for construction firms, it needs to be majority commercial versus residential. And then a majority of the work needs to be self-performed, either 80% or more of the work needs to be self-performed. Any questions on any of that? Okay. I'm going to turn it over to Dan to talk about health insurance captives.
All right, so why would you consider joining a health insurance carrier? Couple reasons. One, you're tired of the increases year after year after year after year after year. And you've kind of had the odd damn moment when your broker calls you and says, Dan, I talked to the carrier, it's 60 days out, they're going to give you a 13% increase. I got them down to 9. Does that sound familiar at all? Maybe yes, no. So it's pretty common. And you never really know where the claims data is coming from, so you don't know how the carriers are coming up with the increases that they are. Really, right now, you have no control over the plan, so you have no control over the costs. Right now, if you're in a traditionally fully insured plan, you're making 12-month buying decisions. So that means that every 12 months, say you're paying $50,000 a month, if there's $100,000 of claims given to the carrier that given month, you continue to pay $50,000 no matter what. So if you have $1 million of claims through a given year and there's only $600,000 of premiums going to that carrier, you're off the hook for 12 months, right? But what's going to happen that 13th month? You're going to get hit pretty hard at renewal time. So typically what's going to happen, like I said, they're going to call you, they're going to say, there's a 13% renewal, got it down to 9. You're going to think back, well, last year was a 13% increase, the year before that was a 6%, the year before that was a 12%. So you're going to say, could you get me some better options? So they'll give you another option with the same carrier. They'll switch up deductibles a little bit, maybe switch up the copay out of network, in-network expense. And then they should also give you alternative options from another carrier. The only thing you have to worry about then is causing some kind of disruption with your employees. So if they're on a Blue Cross Blue Shield network now, and you raise their deductibles a little bit, take them to a Humana network, you or your HR manager is probably going to hear about it from some of the employees, right? So the purpose of this slide is just to show you guys there's really no difference at all between the insurance design fully insured plan and a self-insured plan or a captive model. There's still the network, so typically from one of the BUCA networks, that'd be Blue Cross, United, Cigna, Aetna, Humana. There's the admin costs. Right now, if you're in a fully insured plan, the carrier is kind of bundling it all together, and so they have their own network, they're charging you their admin fees, and then they're negotiating the buying terms of the reinsurance costs, which very similar to the PNC. If you go over a certain amount, the insurance kicks in. And then finally, they're also negotiating the drug discounts that you're getting. Very similar on the self-insured model. The only difference is we kind of separate it. So there'd be the network, you'd hire a TPA to pick one of the BUCA networks. There'd be the admin costs, so you'd have to pay the TPA, you'd have to pay the broker, and then you'd have to pay the captive manager. And then there'd be the reinsurance costs. Sometimes the advantage to working with the captive for the reinsurance costs are the economies of scale. So there's more lives in the game, more belly buttons, so they're able to negotiate better pricing on your behalf. So out of the network, the admin, the reinsurance, take 100% of the spend that you'll have set aside for that year. It's about 30% of the cost. So there's 70% of the funds sitting there waiting to be claims. So I'm going to bounce back and forth a little bit between the financing, the mechanics right now between a traditionally insured plan, a fully self-insured plan, and a captive insured plan. And I'll give you a specific example of where the money kicks into place. That's the same example, but for 3 different scenarios. So with a fully insured plan, obviously there's no short-term risk at all, that being for 12 months, right? If you get a 10% renewal, you're going to pay that 10% for the next 12 months. If you have a 130% loss ratio, well, you're going to find out about it 60 days out, hopefully, right? Then you won't really have any better options unless you take the market. Long-term risk, though, you're probably I mean, no, you are definitely not in good hands. As we all see, I think the average rate right now is 8 to 12% going up for annual increases every year in health insurance. So it's definitely not a soft market for health insurance at all. And that's why if you're a candidate or you want to be a good candidate for a captive or a self-insured plan, now's the time to do so. So I'll give you an example. Say you have somebody that goes on dialysis. They cost you $300,000 throughout the year because they're going in for dialysis twice a week. It costs you $4,000 each time. They do it for about 40 weeks, so that comes out to a $300,000 cost. What's going to happen is you're going to incur the first $100,000 of costs, and then the reinsurance is going to incur everything over that. So yeah, if you're in a fully insured plan, you're safe and sound there for 12 months until the renewal ends. With this one, you're taking on more risk, so you're going to pay more out of pocket. But there's also the second layer of reinsurance cost that kicks in right there. Does that make sense? Follow? So that brings me to the self-insured financing, whereas the long-term risk is definitely a lot safer, it's a lot lower, whereas the short-term risk is higher because you could potentially incur big losses the first year, that being cancer claims, heart attacks. A lot of spouses might have babies. I only see one female in the room, that's why I say spouses. So, anyways, that makes sense? Moving to captives for health insurance. Take the same scenario, somebody goes on dialysis, incurs $300,000 in claims. There's an extra layer to kind of protect you here. So this is the single, meaning individual, aggregate max that you would spend in the first year. So if there's a $300,000 expense, your $30,000 is wiped out like that. The next $70,000 the captive incurs, and then anything over that is where the reinsurance kicks in. Odds are not every company within the captive group itself has the same ongoing problems that you do. So that's why the captive helps offset it. And then that's also where it comes into play with the captive manager negotiating, every 12 months good costs within the reinsurance market. Because if you had a really bad year this year, odds are 5 other companies have had pretty good years. Might be 5 other companies that had average years. Whereas next year, if you had a really good year, there's probably a company that didn't have a very good year. So it kind of brings you to the financing. If you go back, I think it's, and we'll get into what we think the ideal candidate is for a captive in health insurance. But if you're the right size and the right fit to take on a captive employee, a captive benefits plan, then your long-term risk here truly is the lowest because that extra layer of protection. It's about the same as what it would be with a fully self-insured model in terms of the first 12 months because you're taking on more of the risk. You're taking on less of the risk, but you're still taking on more of the risk than you were before. So this is what it's supposed to look like over time. Who sees their health plan in the room? Most of you guys. Does this look fairly familiar? Something pretty similar to that, more or less. Goes up a little, comes down, goes up a little, but over time, it's going up, no doubt about it. Whereas the point of showing you captives and self-insureds, it's not going to go down forever. It's going to come down, but your plan is to kind of even it out so that you know, give or take, how much you're going to pay every single month, and you're able to build up a little bit of reserve within that separate bank account or trust. Does that make sense? So who's a good fit to consider for the health insurance? Companies that have 50 to 500 employees. 50 to 250 is definitely ideal. If you get up around 500, you're probably big enough, quite honestly, to look at getting your own self-administered plan. And trying to reap more of the benefits that you would inside of the captive. You're tired of the annual increases, you desire more claims data and transparency, and you want to take control and get your employees engaged. And a couple of examples of that would be that we do at our company. We require biometric screening. You can put certain things in place to require employees to first look at generic drugs if they're on monthly prescriptions. Not all employees, quite honestly, can do that. Sometimes they need the exact pill that's prescribed by their doctor, but in most cases they can take generic. And those are two very easy, non-intrusive, and non-disruptive ways to save money for your employees and for your healthcare. We actually have a book that has over 100 different cost containment strategies in place that you can roll out to your employees. And what it does, it ranks the level of disruption, and it ranks the level of cost savings that we supply to your company. Finally, after joining, different pros and cons. Pros, lower costs over time. You definitely get more control over your plan. You get complete transparency because you're getting the claims data supplied to you every month by your TPA. So you're knowing how much the claims are that are incurred, where they're coming from, who they're coming from, and then from there you can put different procedures in place to help those catastrophic events from happening. The peer-to-peer meetings are typically for construction. There's one once a year, just giving you ours for example, one in Nashville, and then the construction one is in Park City. So they're extremely beneficial. You talk with your peers, all construction companies, like-minded companies, and you really just hear what other companies are doing to help fight healthcare costs with their cost containment strategies. The cons, I mean, we showed you it very similar to the property and casualty. It could cost you more in the first year. And then second would be, I mentioned where the capital meetings are. You'd have to travel to at least one day a year. At least they're in places where you can, one of them you can drink a lot of beer and listen to music. The other you can do some skiing. So. Adam, finish it off.
Yeah, so I'll be brief on this. Other risk financing techniques, we talked about group captives for property and casualty, we talked about health insurance financing as well. So there's some other risk financing techniques that we should mention that are actually, have been around longer in some cases than group captives. Of course, there's self-insurance, and self-insurance is pretty self-explanatory what that is. That's being independent of the insurance industry and deciding that you're either going to set aside funds or take the risk on your balance sheet by yourself. So in self-insurance, it needs to be a true extreme focus on risk mitigation strategies and loss control. That's typically only going to be viable for larger companies to do self-insurance. And then, for example, if you end up being self-insured for workers' comp, it's still regulated. So we actually administer a lot of self-insured plans because we have an in-house TPA. So if you go self-insured, you got to figure out how you're going to, administer the claims process. You're probably going to hire a TPA, or you're going to do it in-house. So it gets a little bit more complicated. Single-parent captives. So that's actually going to be you investing and putting up capital and starting a single-parent captive insurance company. You want to contrast that with a micro-captive, which I'll talk about next. Single-parent captive, think bigger. That can really be for almost any line of coverage that you want to write into it. We've seen clients that are writing things like if they have a really large directors and officers liability exposure. We've got a large union client that's writing their employment practices and D&O in a captive. What's cool about a single-parent captive? You can actually write third-party insurance into that and treat it as a profit center. So if you were an HVAC contractor and you have warranty programs, you could start to use a captive to finance your warranty program to create an additional revenue stream there. So anytime you have a captive, and I should have said this about the group captive as well, that money that you're putting into the captive is actually earning investment income. So there's an investment strategy there as well, and you're earning investment income while your money sits there in surplus. Micro captives would be the last one. So a micro captive, I talked about enterprise risk to kick this off. So you might think about a micro captive really as an enterprise risk captive. So you are insuring risks in the micro captive that are those things that are traditionally either uninsured or uninsurable. An example of that might be your deductibles. If you have a high deductible on your health insurance plan, you can actually fund for that in your micro captive. It might be cyber liability insurance. You don't want to buy a cyber liability insurance policy because it's tough to justify for a construction company. You actually start to set aside money and fund for it in a micro captive. So this is the captive strategy that you have to put $2.3 million or less into it, and that will be tax deferred. And this is the one that is, these are sometimes referred to as 831B captives because they follow IRS tax code 831B. Any questions about any of those? Questions in general?
The captives that you're discussing, were they national within the United States borders, or were they offshore?
Both. So it's grown in popularity that captives are domiciled in the states. There's a lot of states that have seen that as a revenue opportunity. So there's states like Utah, even Missouri, that have really started to lighten the regulatory environment so that captives can be domiciled there. But for the most part, we're talking about captives that are domiciled in Caymans or Bermuda, for the most part.
Anything else?
What's attractive about the Cayman Islands?
I haven't been to the Cayman Islands.
Board meetings or?
Yeah, so we didn't talk about the board meetings on.
He's a tax. He
Beautiful.
knows what's attractive.
Yeah, so actually,
Beaches and a taxi.
some of those meetings are in awesome places. Obviously, we've also gotten feedback that like they're too time consuming and too hard to get to. I actually went to a captain meeting in Bermuda. I've never been to Bermuda before, but that's an awesome place. It's pretty easy to get to, and you feel you're in Europe basically.
So what are the pros and cons on homogeneous versus heterogeneous captives?
It could be claims handling, it could be loss control. So we've got some clients that are in an electrical contractor specific captive, and obviously like the loss control support that they get and any type of support that they get really knows their industry really, really well. And so that would be one advantage. Heterogeneous, you might not have the camaraderie, and you might not have that specific kind of experience, that experience where everything's been specifically created for your industry. Other than that, the mechanics of it are basically the same. You find that those homogeneous captives, those of you guys who don't know what homogeneous is, that's single industry typically. It might be artisan contractors, or it might be electrical contractors, or it might just be heavy construction. We've got our captive manager starting a new captive for heavy construction right now. So, the mechanics are the same, but you just might decide you just want to hang out with your like-minded people.
So is it better to be in a captive with a group, say, of 30 members versus 100 members?
Not necessarily.
Because with more members, would your administrative costs be a little bit lower?
Yeah, absolutely. So we've seen, there's advantages and disadvantages for both. If you're in a really large setting with a lot of members, you might feel like you're getting lost in the shuffle. You might just feel like a number. And then those captives that are a little bit more intimate, a little bit smaller, you might feel like you really get to know the members. You might really feel like you have a voice and a say in what happens there.
For a larger captive, and you think your spread of risk would be a little bit better for catastrophic loss? I mean, dipping into that bucket a little bit less with more members, I would think.
Yeah, absolutely. It should be. And it should be a little bit more mature of a captive too. That would have more surplus built up.
So we have a self-funded health plan with 160-ish participants and 280 80 belly buttons. And we're entering our 4th year, and it's been fantastic. In our first year, we had a cancer patient, and we had some stem cell transplantations that really drove up our stop loss. We have an $85,000 individual deductible. And we've had 3 consecutive years with almost no losses. And we cannot get our stop loss premiums in. So short of having another broker look at it or something, is there a captive for the stop loss piece that we can look at?
Yeah, answer that.
Not a captive for
We
the
just
stop loss
can't
piece.
get
I know.
the carrier to move down off of.
I know what our captive does, the one that we work with, quite honestly, 100% on the health benefits. They would take a look at your plan design, and then they would right off the bat offer to decrease it by 2.5%. And then look at your plan design, they look at your claims, since you have access to your claims data for the past 4 years. And that could potentially make a marker. But no, you can't create a captive inside of the captive. Does that make sense? Because that would be, there'd be the group captive, and then I think, correct me if I'm wrong, you're asking, can you create a captive for
Just the
the
stop
reinsurance
loss.
portion?
Just the stop loss.
Anything else? Obviously, this was educational, but if you'd want to leave your card or anything, Adam and I would be more than happy to talk to you down the road too, if you'd be interested.
Yep, there's my contact information. We appreciate you guys' time.
Thank you.